Validation is rational. Euphoria is dangerous. If the market moves against you, it doesn't crush your confidence. It simply gives you information. With a tiny line on, a loss isn't catastrophic. It's educational. You can tighten up, reassess, wait for a cleaner setup. You don't have to defend a position you regret entering. When the market does confirm your direction, that's when adding makes sense. Adding after confirmation means you're increasing size when the odds have improved, not when your confidence has inflated. And the difference between those two things is the difference between survival and destruction. The market confirming your first entry means buyers are stepping in again, or sellers are failing again, or momentum is building in the direction you anticipated. It means the story you thought you saw is actually unfolding. Most traders don't realize how powerful this step-by-step escalation can be. They think adding slowly means missing the move. They think a small first entry means a small profit. But the truth is, the biggest profits I've ever seen traders make, and the biggest I ever made myself, didn't come from going all in at the start. They came from pressing the advantage as the market proved the initial idea correct. That's how you build a real position, not through hope, but through proof. Ask yourself this: how many times have you taken a big first entry, watched the market dip slightly, panicked, cut the position, and then watched the price sprint in the direction you originally expected? That happens because your size was too big too early. A small first entry would have kept you relaxed, patient, and available to add when the real move began. Heavy size makes you fragile. Light size makes you observant. There's another layer to this principle, one that isn't obvious until you've traded long enough. Starting small trains your discipline. It teaches you to wait for the market's permission instead of assuming you have it. You begin to appreciate that being early can be just as costly as being wrong. You learn that confirmation is not something to take lightly or rush past. Patience becomes profitable not because waiting itself makes money, but because waiting prevents you from making expensive mistakes. Starting small also protects you from that destructive impulse to force the market. When you place a small test position, you're acting out of curiosity. When you place a huge one, you're acting out of conviction, sometimes false conviction. And when the market pushes back against false conviction, traders don't respond rationally, they respond defensively. They double down. They widen stops. They rationalize. All because they started too big. A small beginning eliminates the psychological pressure that comes from trying to be right immediately. You don't need to be right immediately. You just need to be in early enough to identify the real shift and ride it when it comes. And there's something else too. Starting small makes you more selective. When you know your first entry is small, you're less tempted to chase every setup that looks promising. You pick only the clean ones. The ones that show tight structure. The ones that move with intention, not noise. That selectiveness improves your overall trading quality. You begin taking fewer trades, but better trades. You begin seeing setups not as opportunities to jump, but as opportunities to test. And not all tests need to be taken. The market is a teacher, and the first entry is the moment you ask your question. If the market says yes, you continue. If it says no, you step aside. Starting small isn't hesitation. It's intelligence. It's respect for uncertainty. It's the recognition that the market doesn't pay you for being early. It pays you for being correct, and correctness reveals itself over time through movement, structure, and confirmation. Adding only after clear, favorable price movement, never during hesitation, is one of the simplest rules to understand in theory, yet one of the hardest to follow in real trading. The idea sounds straightforward: wait until the market shows strength before you increase your position. But when you're actually watching the chart tick by tick, and your emotions begin whispering in your ear, that simple rule becomes a test of discipline. You see a little rise, a flicker of momentum, and something inside you wants to jump in with more size right away. But the truth is, favorable movement isn't just any upward wiggle or downward dip, it's decisive pressure. The kind that shows intent, not randomness. Most traders make the mistake of adding during hesitation because they confuse hope with confirmation. They see the market stall for a moment and tell themselves the pause is normal, or that it's coiling for a move. But pauses don't necessarily mean strength. Sometimes a pause is indecision, weakness, or exhaustion in disguise. And if you add while the market is uncertain, you're betting your money on noise rather than direction. Ask yourself how many times you've added during a stall, only to watch the price slip the other way and take your new position with it. Clear, favorable movement means the market is walking firmly in the direction you want it to. It means buyers are pushing with consistency in an uptrend, or sellers are driving cleanly in a downtrend. It means the candles aren't just twisting around, they're progressing. When the market behaves like that, it's as if it's saying, yes, you interpreted the structure correctly. Yes, the pressure is real. Yes, the path is clear for now. That's when adding makes sense, when the chart itself aligns with your original thesis. The key here is to make sure you aren't tricking yourself by calling a small blip favorable movement. Markets are notorious for giving little fake out moves that last 5 minutes or 5 bars just to rope in impatient trader. The movement you add on must be meaningful. It must break a level, reclaim a level, or accelerate in the direction of the trend. It must show intention. If it doesn't show intention, you're gambling. Waiting for meaningful movement protects you from reacting to noise. When a stock is truly moving, you'll feel the difference. It moves clean. It moves with rhythm. It brushes off minor pullbacks and keeps climbing or falling with purpose. That's when adding enhances the position instead of exposing you. But during hesitation, those choppy, sideways uneven stretches, adding is like putting your weight on a shaky branch. It might hold, or it might crack. And trading is not about hoping the branch holds. It's about stepping only on the branches that prove themselves sturdy. Another piece of this principle is psychological. Adding during hesitation often comes from impatience. You want the trade to develop faster. You want to be fully positioned now. You want to catch the whole move. But trying to force size during hesitation is like trying to force the market to accelerate before it's ready. No matter how much you want the trend to start or continue, the market doesn't move because you want it to. It moves when the participants behind the price decide to push. Adding on hesitation also reveals an emotional flaw, the desire to be in, rather than the desire to be correct. When you catch yourself wanting to add just because you fear missing out on the next leg, that's not analysis, that's anxiety. And anxiety is expensive. Favorable movement, on the other hand, gives you clarity. It removes the ambiguity. It tells you objectively that the market is progressing. Adding into strength is one of the few behaviors in trading where your psychology aligns with probability. Strength rewards the trader who respects it by adding only after it shows itself. Another reason you avoid adding during hesitation is that hesitation can be the early sign of a reversal. Trends don't reverse out of nowhere. They stall first. They lose momentum. They start to confuse traders. They create little traps. If you're adding during these traps, you're adding right before the market turns. That's why disciplined operators wait. They watch the hesitation play out. They wait for the market to either break through decisively or show weakness. They don't commit more size when the signals are unclear. Think about how professionals build positions. They don't throw size around just because price wiggled in their favor for a moment. They study the structure. They wait for continuation. They look for the market to show pressure. Only then do they press their advantage. And that's what pyramiding is really about, pressing your advantage, not pressing your luck. Every time you add on hesitation, you're increasing your exposure at the moment when your advantage is the smallest. Every time you add on strength, you're increasing exposure when your advantage is the largest. That difference is subtle on paper, but enormous in your account. The market pays you for aligning size with strength, not aligning size with emotion. When I watch newer traders add during hesitation, I can see the thought process behind it. They think they're being bold, aggressive, decisive. But in most cases, they're just being premature. A premature add on inflates stress without increasing odds. It creates pressure without improving position. It forces you to babysit the chart because every tick suddenly matters. But when you add on favorable movement, you feel different. You feel grounded, confident, not because you're predicting anything, but because the market has already shown its hand. Favorable movement is the market pulling you forward. Hesitation is the market warning you to slow down and learning to read that difference. Really read it is what allows you to build structured, confident, and sustainable positions instead of messy, fragile ones. Adding only after true movement is like waiting for the wind before you raise your sail. Without the wind, the sail is just fabric. Without the movement, your add-on is just risk. And the more you train yourself to wait for clarity before committing additional size, the more your trading begins to feel controlled. You take fewer impulsive actions. You stop trying to manufacture momentum. You begin letting the market do the heavy lifting, and that shift, from forcing action to responding to evidence, is what gradually turns impulsive traders into composed ones. Treating each add-on like a test the market must pass, rather than a guarantee of continuation, is one of the most important mental shifts you can make if you want to pyramid correctly. Most traders think of an add-on as a reward, a victory lap, or proof that they were right from the beginning. But that's the wrong attitude entirely. Every time you add to a position, you should be challenging the market, not congratulating yourself. You're saying, show me again. Prove the trend is still healthy. Prove the pressure is still real. If the market can't prove it, you don't give it more of your capital. A lot of trouble in trading comes from assuming that once the market begins moving in your favor, it will keep doing so simply because you want it to. That assumption is costly. Trends don't continue because you're in them. Trends continue if the underlying forces, buyers or sellers, remain dominant. Your job is to find out whether those forces are still present, still pushing, still hungry. An add-on is a question. And you only increase size when the market answers correctly. Think about it this way: your initial position is your hypothesis. Your second position is your first test. Your third position is your second test. You don't keep adding because the market moved once. You keep adding because it keeps passing test after test. And each test must be a little more demanding than the last. If the trend is real, it will not stumble over a small test. If it's weak, your test exposes that weakness before you've risked too much. This mindset prevents you from confusing a temporary bounce with real strength or a shallow dip with genuine continuation. For example, suppose you're long in an uptrend. You bought the breakout. The stock moves up. Good, that's the first sign of strength. But does that mean you should add immediately? Not necessarily. Ask yourself, what is the next test? Does price hold above a prior resistance level? Does volume support the move? Does it avoid deep pullbacks? Does it push through the next small barrier without hesitation? These details matter. If the market fails any of these small tests, why would you increase your commitment? Most traders treat add-ons emotionally rather than analytically. They say, it's going up, I have to add now or I'll miss it. But pyramiding isn't about chasing speed, it's about measuring strength. When you treat every add-on as a test, your emotions no longer dictate your timing. The market dictates your timing, and the market is always more honest than your impulses. You must also understand that each add-on raises your exposure. Even if your earlier positions are comfortably in profit, the newest entry is always the most vulnerable. It sits at the highest point in the structure, where the distance to support is longer and the margin for error is smaller. That's why it's crucial that you only add when the market proves it can handle the weight of a new position. If it can't, you stop. You don't argue with the tape. You don't plead for continuation. You simply accept that the trend has failed the test for now. Another benefit of this test mentality is that it keeps you from building top, heavy pyramids. If you add without testing, you might stack too much size at the top of the move. Then all it takes is a routine pullback to shake your entire structure loose. But when you test before adding, you naturally build the position in a stable way. Big at the bottom, smaller as you climb. A real pyramid, stable, logical, supported, It also changes how you interpret losses. If you treat an ad on as a guarantee and it fails, you feel betrayed by the market. You feel wrong. You feel frustrated. But if you treat it as a test, the failure feels informative rather than painful. The market didn't betray you. It simply told you the trend wasn't ready. That mental shift reduces emotional strain, which is one of the biggest drains on a trader's consistency. Have you ever noticed how calm professional traders look compared to beginners? It's not because they don't lose. It's because they test the market constantly instead of throwing themselves at it. You know, in this business of speculation, every man eventually learns that the market doesn't pay you for excitement. It pays you for correctness. And today, I want to talk about something traders hear about, but rarely apply the right way: pyramiding. But before we get into the meat of it, let me say this naturally, just like I said in the previous video on, you'll lose money if you keep doing this. Most folks lose because they keep repeating the same sloppy habits. Pyramiding, done right, is the opposite of sloppy. It's deliberate, it's calculated, and it's the only way I ever built a position big enough to mean something. Now, let me talk to you plainly, the way I always did when I spoke to young traders. I never believed in taking a full position right off the bat. Why should I? Why would you? If your first shot is nothing more than a test, why bet the whole farm before the market confirms you're right? A lot of people think pyramiding means adding recklessly just because the price goes your way. But tell me, doesn't that sound like the behavior of a gambler, not a trader? When I stepped in, I always wanted the market to prove I was right before I pressed my advantage. That proof came in the form of movement, clean and decisive. I'd buy a little when I saw the first sign. Then I'd wait for the market to show me a second sign, and then a third. Each time it did, I'd add. Each time I added, my risk grew smaller because the trend grew stronger. You see the shift? I wasn't adding to hope. I was adding to confirmation. Maybe you've noticed this in your own trading. You get in, the market goes your way a little, and suddenly you feel smart, and then you get bold, and then the price snaps back on you, and you're confused because you thought you. That's what happens when the market moves once, but you let your emotions move 10 times. So let me ask you, how many times has your conviction outrun the chart? Pyramiding the right way isn't emotional. It's mechanical. The market says, yes, and you increase. The market keeps saying, yes, and you increase again. You don't add when it hesitates. You don't add when you're unsure, and you definitely don't add because you're trying to force a win. The market doesn't respond to force. It responds to facts. The steps I used were simple. First, identify the line of least resistance. That's just a fancy way of saying, find the path the market is already walking. Why try to drag it uphill when it clearly wants to move downhill? Or the other way around. Once I saw that path, I dipped my toe in. A small line. Hardly enough to matter. But it wasn't supposed to matter. It was supposed to be a test. Think of it as your way of asking the market, are you truly ready to go? And then the next step was patience. Patience that most traders lack. Patience that costs nothing and saves fortunes. If my first purchase showed a profit, I didn't pat myself on the back. I didn't celebrate. I simply watched to see if the market could push further. Because if it did, that meant buyers were still hungry or sellers were still desperate. Whichever side I was riding, and if they were, then and only then did I add my second line, but never as big as the first. Your first entry should always be your largest. Why? Because it's the one taken at the lowest risk. Every new entry is deeper into the trend, which means your advantage is greater, but your distance from the base is longer. Have you ever added more size on your second or third entry than your first, only to feel pressure the moment the price twitched? That's the burden of poor structure. A pyramid must have a wide base, not a wide top. And let me remind you of something important. This ties right back to that earlier point from the previous video about losing money when you keep repeating the same sloppy behavior. Pyramiding is discipline in action. It forces you to slow down, to wait, to think. It saves you from swinging wildly and then wondering why your account keeps shrinking. One thing I always respected about the market is that it doesn't hide its intention for long. When a stock is ready to run, it acts like it's ready. It pushes. It breathes with momentum. It shrugs off weak pullbacks. And when you see that kind of behavior, that's when you add. And you ask yourself, why wouldn't I press the advantage when the market itself is giving me the green light? But listen closely. Pyramiding is not averaging up blindly. It's not throwing good money after the thrill of movement. It's adding only after the market does what you expected it to do. The trend must be clean. The structure must be tight, and your mind must be steady. I've watched many traders get excited after one good move and start behaving like they've caught the next great fortune. That excitement is dangerous. The market doesn't care how excited you are. The market cares about pressure, momentum, volume, and participation. If none of that is there, then adding is foolish. If all of it is there, then adding is merely logical. Think about this. Would you hire an employee based on one good day? You'd want to see consistency, wouldn't you? You'd want to see if he can handle pressure, if he performs well when conditions change. The market works the same way. Prove yourself, then I'll commit more. A proper pyramid in a rising market looks like a staircase, not a cliff. You climb one step, you test it, then you climb the next. Each step supports the last. Each position supports the next. And your stops rise with your entries, which means the worst thing that can happen is you walk away with a small win or a scratch. Now tell me, doesn't that sound a bit more sensible than swinging your entire account at the first sign of life? The biggest mistake beginners make is thinking pyramiding is about building size fast. It isn't. It's about building size correctly. It's the difference between a fortress and a pile of stones. The fortress takes time, structure, and intention. The pile of stones takes nothing but carelessness. And I'll tell you straight, pyramiding taught me more about money mindset than any other method. It trained me not to rush. It showed me that the market gives larger rewards only to those who earn them through patience and proof. It reinforced that conviction must come from price, not ego. Ego is expensive. Price is honest. So when the market moved in my favor, I didn't get excited. I got attentive. I watched how it behaved at each level. I paid attention to how it handled resistance. I noticed whether it hesitated or surged, and each time it confirmed strength I added, not blindly, not emotionally, but methodically. And the beauty of pyramiding is that it teaches you respect. Respect for the market's movement and respect for your own capital. It keeps you from overexposing yourself at the wrong time. It keeps you connected to what the chart is actually saying. Because charts, if you listen, will tell you the truth far more often than your own impulses will. When I say your first entry carries the lowest risk, I'm not speaking in metaphors or theories. I'm speaking from decades of watching markets break men who misunderstood where real danger hides. The first position you take in a trend is the only one placed before the crowd wakes up, before the excitement builds, before volatility expands, and before price puts real distance between your entry and the base of the move. That first step is like setting your foundation on solid ground. Everything after that is built higher, further from support, and therefore naturally riskier, even if the trend is strong. Think about it this way: when you buy a stock at the very beginning of a move, you're close to the point where the market first turned in your favor. If you're wrong, you find out fast and cheap. If you're right, you're positioned early, while risk is tight and the reward is open-ended. That's why I always wanted my largest line to be the first. It had the best possible asymmetry. Small risk, large potential. Every additional line had a great potential too, but it was never as favorable as the very first one. Picture yourself watching a stock form a solid base, moving sideways, building energy. You notice the tightening of the range, the drying up of volume, the subtle shift that tells you pressure is accumulating. Then, one day, price breaks through the level you've been watching. That breakout is your invitation. You take your initial position. Not large enough to matter if you're wrong, but meaningful enough to participate if you're right. And here's the part most traders miss at that moment: your risk is defined by the structure. Your stop can sit just below the base, a clean, logical chart-based exit. Now fast forward. The breakout holds. The stock pushes higher. Maybe it pulls back a little, then surges again. This is where most beginners suddenly get bold and start loading up aggressively, thinking the trend has now proven itself. But stop and ask yourself, is the risk lower now or higher? You're no longer near the base. You're further away from support. A pullback now can be deeper, faster, more volatile. If you add more size now than you did earlier, you've flipped the pyramid upside down, and any wobble in the trend will pressure your entire position. You see, each time the stock climbs, it's moving into new territory, often filled with unknown sellers, profit takers, and emotional traders reacting late. The market becomes more crowded, and crowded rooms can turn quickly. Your later entries, even if correct, sit at a higher altitude. They're more exposed. They need the trend to keep proving itself. That's why they must be smaller. They're passengers riding on the strength of your initial base position. Your first line is your anchor. It's the one that steadies the whole structure. When traders reverse this and make their later entries their largest, they're asking the market to support a top, heavy structure. And when the market breathes, not crashes, just breathes, the whole thing tilts. Have you ever been shaken out of a winning trade because your later entries were oversized and forced you to cut everything when the market made a routine pullback? That's the cost of misunderstanding risk distribution. I learned early in my career that market moves are rarely smooth. They surge, they pause, they retest, they shake out the weak hands, and then they continue. If your largest size is sitting at the highest price, you become one of those weak hands without meaning to. The pullback forces you out, even if the trend is still intact. And ironically, your very first entry, the safest one, might have survived just fine if you hadn't piled size on top of it. That's why I say the risk climbs with the height of your entries. You must structure your ads so the foundation supports the tower, not the other way around. Another thing beginners misunderstand is that the profitability of early entries can mask the danger of later ones. The floating profit on the first position may make your account look strong, but that's not a cushion you should rely on blindly. Floating profit is not achieved profit. It's simply market permission. Permission that can be revoked at any moment. When you add too aggressively later, the temporary comfort of earlier gains blinds you to the fact that your newest positions are still naked. They have no cushion. They have no margin for error. They're relying entirely on continuation, and trends don't continue just because you need them to. The beauty of pyramiding correctly is that it lets the market fund your aggression. You add size only after you're already in profit, and each ad is smaller, lighter, easier to unwind if needed. This way, even if the trend snaps back, your biggest position, the first, still gives you room to breathe. You can scratch the later ones or cut them with minimal pain because they're not oversized. Your job as a trader is to make the structure of your position mimic the structure of the trend. Early strength supports later strength. Early clarity supports later conviction. And early risk control supports later size. When your position mirrors the market's behavior, you move with it instead of against it. You understand that as the trend extends, uncertainty grows, not shrinks. That's why every new ad on must respect that growing uncertainty. So when I placed my first line, I treated it with the seriousness of planting a flag. It was the only entry where the market hadn't yet confirmed anything. And yet, paradoxically, it was the one with the least exposure. Every other line came only after I had earned the right to add by being correct. Starting a position small and letting the market prove you right before adding isn't just a technique. It's a mindset shift that separates a careful operator from an eager gambler. Too many traders step into the market as though they already know what's going to happen. They load up big on the first entry because they're convinced the trend is obvious, the setup is perfect, and the outcome is practically guaranteed. But the market does not reward certainty. It rewards verification. It rewards the trader who treats that very first entry as a question, not a declaration. When you start small, you're acknowledging a simple truth. The market doesn't owe you confirmation just because you spotted a pattern. You might be right about the direction, but timing matters just as much. Maybe the breakout you're expecting is still a day away. Maybe the sellers need to exhaust themselves. Maybe a news event is around the corner. A small position lets you stand at the edge of the water and see if the tide is rising or falling before you dive in. It's a test, a probe, a way of asking the market, are you aligned with my idea, or am I early, or worse, wrong? Think about how different that feels from dumping a full position on your very first entry. When you load up big, you're emotionally attached right away. You're tense. You stare at every tick. A tiny pullback feels like a threat. You're not observing the market. You're reacting to it. That emotional tension clouds your judgment, and suddenly you're no longer analyzing, you're hoping. Starting small protects you from that shift. It gives you room to think. It gives your mind the space to watch the market without being held hostage by your size. The beauty of starting small is that it transforms the way you interpret movement. If the market goes your way, you don't feel euphoric, you feel validated.